Welcome to the Accounting Profits and Prosperity Show. I am your host, Louis Prosperi. Our guest today is a renowned speaker, business strategist, the founder of the Value Builder System, and an accomplished author. Today, we're going to talk about one of his best-selling books, The Automatic Customer. Please welcome John Warrillow. Welcome, John, to the show.
Hey, Louis, good to be with you.
So one of the things I found interesting, John, was that you wrote your book, The Automatic Customer, 9 years ago. And what's really interesting is that I think it's more relevant today with the accounting profession than it ever has been. It felt like when I read it, I think 6 or 7 or 8 months ago, that it was written just recently. So tell me a little bit about what you've experienced since you've written the book related to the automatic customer and subscription model.
Yeah, but I think business to consumer models are mature. There's even a little bit of subscription fatigue. If you get your kind of credit card statement, there's just hundreds of little charges from everyone from Netflix to, your local car wash. And as a result, I think in the consumer market, there's a little bit of subscription fatigue. However, contrast that with business to business. I know we're talking about accounting firms deploying the subscription model. I think it's fertile soil. I just still think there's a ton of transactional business to business companies out there that are missing this as an opportunity. So I think there's still a ton of field left to plow, so to speak, in the B2B world.
Well, I think you hit it right on the head because the accounting profession, when I looked at how you described these subscription models, the key focus for us is we're using the billable time and so forth. And technically, our model is designed on relationship building. And I think your subscription model is more geared to relationships than it is to transactional function. And the B2B is, let's be honest, a lot of them are relationship oriented. So I think it's a perfect model for the accounting industry. What's been your experience with accountants so far? How have they accepted the automatic customer? Have you had any feedback on that?
I mean, it's a mixed bag. I think there are a lot of accountants that bill kind of on a subscription model now and have a kind of a managed service model. But there's still kind of the time and material folks out there who are really clinging to the billable hour as the sort of way that they structure their agreements. Now, some of those billable hour folks have sort of packaged their work into sort of an annual agreement. But still, when you unpack the annual agreement, it's really just a function of how many hours are they consuming of our time. So I would say it's a mixed bag across the accounting professional in my experience.
I agree with you 100%. The mixed bag. I think you're right on that. The interesting thing about your book that I really enjoyed was the fact that you didn't have one size fits all. You literally developed what I would call 9 subscription models for different industries or different methods of business to business relationships. And the 3 that I would really like you to focus on, because I think they're most relevant to our profession, is the front of the line model, the simplified method, and the peace of mind. If you could go through each one of those and sort of just highlight the concepts of each one, that would be fantastic.
Yeah, I'll start with front of the line. I mean, when I grew up, I was told to wait my turn, right? Like as a kid, you're sort of like, wait your turn, your mom slaps your hand. And yet these days we are paying to jump to the front of the queue, right? You can go to your airline check-in counter and there's a special queue for people who've got the credit card that they paid for that entitles them to jump the queue. And that's like throughout society. Even subscribers in car washes have a special queue now, right? So if you're a subscriber, you get a special lane to jump the. So we're kind of very used to this experience of paying to jump to the front of the queue. And so the idea behind the front of the line subscription model is that people will pay you to get expedited service. People will pay you to give them the first available time of the partners in your firm. And you can see this, like the software guys are the ones that have really pioneered the subscription model, and they've been billing on a front of the line model for ages, right? Like, so if you're a Salesforce.com user, or even a QuickBooks user, you can like submit a ticket and they'll get back to you like 3 days later, or you can buy a service plan. And I underscore the word buy. So you purchase this and you can get up to 1 hour response time from IT support. That's not for the software. That's just for the chance to jump to the front of the queue. And so I think there's lots of examples of this where people are paying for their time, right? Even concierge medicine. Most people argue you're not getting a better doctor you're just jumping the queue. You're getting a better experience as in terms of going to a doctor. So from an accounting profession, there's an opportunity to kind of carve off your subscribers and give them a higher level of service.
I really like that because one of the things in your book talked about catastrophe. If you're sensitive to catastrophe, and as an accountant, all of our customers feel like they're always in a catastrophe. So access to us is critical to them, and I think we don't factor or price it in. And I like the fact that this model builds it right into the pricing or the value proposition.
You've got to have a good level of service as a benchmark, right? So at the end of the day, accounting, professional service, the underscore the word service, it is a service industry, right? So we have to provide a decent level of service to all of our customers, yet there is another level, a white glove service level, a premium level service that would say, hey, during these hours or during this time at tax season, for example, when time is at a scarce commodity, this is how we will prioritize inbound requests, for example. So you can package that as part of the value proposition to subscribing. And by the way, you mentioned these 9 subscription models. One of the kind of core pieces here is that they're not mutually exclusive. So as we work through them, they can be combined to create a much more compelling value proposition. So with accounting, would front of the line be enough to get someone subscribed? Maybe not. But if you combined it with one of the other of the 9 subscription models, then you start to sort of see a much more compelling value proposition. So the other one you mentioned, I think, is
the simplified method.
Yeah. The kind of core insight around the simplifier is that for a segment of the market, they will pay for you to simplify their lives. We've all, we all know those people who are super price sensitive, right? They want you to itemize every hour you spend on their account. And we know those people exist, right? But there's another segment of buyers for whom price is not the key determinant on their relationship. Their time is a higher premium, right? And so for those folks, they will pay a premium if you simplify their lives. So for example, proactively managing bank recs and accounts payable, you're doing all of the things that simplify the life of the customer on subscription. So you don't have to ask the business, would you like me to do your tax return this year? Obviously, that's a silly example, but in the simplifier model, you're assuming that you are being asked to do that. So again, you're simplifying their lives. So in the old model, in a transaction model, you would wait till the customer asks. And in the simplifier model, you say, what would simplify their life? Let me put that on subscription. And so it's a difference in terms of being proactive versus reactive. And that's the essence. In a B2B context, it often comes down to like a service contract that says, hey, we know you have these needs, so we're just going to kind of package a service contract together and agree that over the next year, we'll support you in these 3 ways, and we'll just send you a monthly bill.
Perfect. And the peace of mind, just to briefly talk about that one.
Yeah, peace of mind is just an insurance policy, right? If you think about it, we buy insurance all the time for all sorts of things. And the reason we do that is because we want peace of mind that in the event of a disaster, we're covered, right? We don't expect the disaster to happen, but we do like the peace of mind to know that if it does, we're covered. So for example, nobody wants to be audited by the IRS, but you could see a subscription model that says, look, in the event you were audited, we will undertake up to X amount of money to fix the problem or to reconcile with the IRS, et cetera. So again, it's this peace of mind. Like I want to go back to making my widget, selling my cars, doing dentistry, whatever it is that I do. And I want you to simplify my life. And one of the ways to do that is a simplifier model. The other is through peace of mind, just to know that like in the event something goes wrong, you've got me covered.
So John, you actually read my mind. The reason why I put all 3 of these together is because the hybrid of all 3 of these basically suit a professional firm. When you add the 3 models, and if you incorporate that into your model, I think really well. So I'm glad that you mentioned that you can blend and combine these models to make it specific for you. So that was great. Thank you for that. That's one of the things that I liked about how your book was designed. It allows you to combine and match. One of the things that I really enjoyed about your book, which is really key to a knowledge industry is that subscription model isn't where someone owns something. They're technically renting, or if I understand correctly, and I could be paraphrasing this wrongly, but it's particularly when it comes to expertise and knowledge, you can't own the firm's expertise and knowledge, but you can rent or have access to it. And that's really the core of subscription. Is that correct?
Yeah, essentially, subscription at its core is a billing strategy, right? Instead of spending the time, counting up the hours, sending in the invoice, waiting 60 days to get paid, which is a negative cash flow cycle, requires you to keep timesheets and so forth. You're saying, we're going to just agree up front that these are the services we're going to provide you over a period of time, and we're going to bill you in this cadence in perpetuity. So the essence of a subscription model, or one of the elements, is that the assumption is that you have to turn it off as the customer. We're going to proactively bill you unless you tell us to stop. And we all know Netflix doesn't ask us, hey, do you want us to bill you this month? It's like, no, we assume that you're going to be billed, and we all have the right to cancel it, but it's on us to cancel it. So that's essentially the essence of the subscription model.
What's interesting is you also talk about the new math, or the new math related to subscription models, because the valuation is different, right? Could you go through some of the key things like lifetime value, customer acquisition cost, and the churn? Those are probably the three key components when you talk about the new math related to a subscription model.
Yeah. And this really does come out of the software world, who, as you know, has sort of taken over in many ways. Software is eating the entire world, so to speak. And they have really pioneered this subscription business model. And they use, one of the metrics they use to evaluate the quality of a subscription company is something called LTV to CAC. So LTV stands for lifetime value, and its relationship to CAC, which stands for customer acquisitions cost. And what they're looking for in software is at least a 3-to-1 ratio, meaning for every dollar of customer acquisition costs, you're getting at least $3 of lifetime value from that customer. And the reason for that is that if you think about it, when somebody bills monthly, instead of getting a once a year check for $5,000 for the tax return, you instead get 12 beautiful little payments of $400 a month. And each individual payment doesn't seem worthy of investing a lot in sales and marketing. But when you look at the lifetime value of a subscriber, which could stretch into many, many, many years, many thousands of dollars, it suddenly suggests that we spend more on sales and marketing. And so that's why the software companies came up with this LTV to CAC ratio, because they were seeing that a lot of subscription company operators were underinvesting in sales and marketing, wanting to recover the amount of money it costs to win a customer in the first month or two. The pioneers of this data point, this ratio, were like, hold on, we're setting unrealistic expectations around marketing payoff. We've got to look at the entire lifetime value of this subscriber, and then compare it to the cost, the costs it takes for us to acquire one. And what we know in accounting in particular is accountants wildly underestimate the LTV to CAC of their relationships, and wildly underestimate their investments, or underinvest, I should say, in marketing. It's one of the biggest opportunities most small, medium-sized firms have, is like literally adding a zero to your marketing. Because what I've experienced, having worked with lots of accountants, your LTV, lifetime value of a customer, is through the roof. Right? Because once somebody has an accounting firm on contract, they're doing the tax, the last thing that business owner wants to do is change accountant. And so as a result, your lifetime value stretches many, many years. It's not uncommon to have 8, 10, 12-year relationships in accounting. And if you actually look at how much value that relationship derives through the life of the value, you would go well past 3-to-1 LTV to CAC. And my guess, most accounting firms are like double digits. They're like 10-to-1, 12-to-1, 13-to-1. And an accounting firm, a software company looking at an accounting firm would salivate for those kind of numbers. They would be like, where do I sign? How do I become an accountant? Yet most accountants are incredibly conservative when it comes to marketing. If you do this math and you figure out your LTV to CAC and it's north of 3-to-1, my guess is it's going to be 6, 8, 10-to-1. it's time to invest in marketing, because for every $1 you spend on customer acquisition costs, you're getting, again, $5, $8, $10, $12 back in terms of lifetime value. It's one of the biggest mistakes I think accounting firms make as it relates to adopting the subscription model is not investing in marketing, because the LTV is massive when you look at the length of time most small businesses stay with their accounting firm.
So that goes right into churn, because then accounting firms tend to have a very low churn. Just explain to them what churn is.
Yeah, churn is when somebody cancels, right? So when you've got somebody on subscription or on a service contract or a simplified model, for example, and they say, you know what, I'm not going to continue. I'm going to change my accounting firm, as an example. That's considered churn. And there's two ways to measure churn. Well, there's a couple of ways to measure churn. One way to think about it is logo churn, and the other is revenue churn. Again, this comes from the software world, where logo churn refers to a business that you work with today stops doing business with you. They say, we're canceling all of our accounts. Revenue churn is a reduction or an increase, or in the case of churn, it's a reduction in the amount of dollars you get from subscription. So let's imagine you're getting $5,000 a year from a customer, and they winnow down and negotiate hard, and you agree to charge them $4,000 a year next year. They're still a subscriber, but your revenue churn is gone up. In this case, you've lost $1,000 of subscription revenue. And the other way to think about subscription churn is avoidable versus unavoidable. And in the small business market, unfortunately, you do have some unavoidable churn, right? So people retire, people merge. Sadly, some people die and their firms no longer exist. Like, there's all kinds of things that happen that are totally out of your control as an accounting firm. Those are all uncontrollable churn. Whereas controllable churn is when one of your clients says, no, I think I'm going to get better service at a firm down the street. And that's what you really want to minimize.
We've talked a little bit about the math, and I think we could spend a whole few hours on the math component, because I read your book, and first of all, the math is very interesting, because it's not the way we normally think about return on investment and value. Income statement, balance sheet don't really work on a subscription-based model from what I'm seeing.
Well, they work. I should just interrupt. They work, but at scale. So the problem is that we look at a subscription model early in its lifetime, right, in the first year or two, and try to do a P&L on it. Well, by definition, if your lifetime value is 8 years, if your average client stays with you 8 years and you do a P&L at year 2 of your subscription model, you're leaving 6 years worth of revenue you're going to get from that customer off the equation, right? You're just looking at it, well, what do we get this year? And so you've got at scale, like a company like Salesforce or a company like Microsoft that has obviously huge subscription revenue lines. I mean, you can look at them on a profit and loss statement, right? Because they're at a maturity level. But most people look at a P&L on a subscription model in month 1 and think, oh my gosh, this is totally underwater. And what they're not realizing is they've got to look at it through the lifetime of that relationship.
Well, that's great. Sorry for miss. So basically, the difference is the PLL is based on lifetime value, not 1 year or 2 years. Well, that's great. Now, the other thing that you brought into your book is the psychology of subscription models, and you went into 2 categories. One was the customer one, and the other one is getting your team on board. Talk a little bit about how important it is for the firm to be on board on subscription, because that's probably a very critical aspect of the model.
This is a tough one. And I learned this myself 20 years ago. I used to own a market research company and professional services. And, we had a lot of market researchers on staff who consider themselves first professional market researchers and second employees of our firm. And we decided to move that market research firm to subscription model. Now, if you know anything about the way market research is typically done, it's on a project basis, right? And so the prevailing kind of industry model is a project basis, similar to the way accounting firms, the prevailing model is billed by the hour. And so when we moved to subscription, we had a lot of our employees quietly resisting the move in the background, because that's not the prevailing wisdom in the industry. And they were worried more about their resume, their career mobility, than the success of our company. And that's not a criticism of those people. They're just looking out for themselves and their career, right? And so when you start to say, instead of, doing projects in the case of market research, for fancy clients with, big sort of groundbreaking research, and you move to a subscription model, which treats people usually, give or take, more in a cookie cutter fashion, they were hesitant to do that. Again, in the accounting world, you may have accountants on your staff who have been trained in the idea of, well, I've got to do a timesheet. I bill for my time. That's the way sort of I'm recognized as my hourly rate. Oh, I'd love to get to a higher hourly rate because that means I'd get more personal compensation. And you all of a sudden rock up and say, oh, no, we're scrapping the hourly rate. We're going to go all in subscription. Like that's going to rock their world. And they may look at their own career mobility and say, well, I don't want to work for this firm forever. I may want to work for another firm. And if I'm not being recognized for my billable time, and if it's a different model, maybe my career status diminishes if we go to some quackamamie sort of model called a subscription model. And so your biggest sales job may be internal. It actually may not be external. It may be to get your employees. And again, let's generalize. Okay. So people who go to work in the accounting profession, I think it's fair to say, I'm not an accountant, so it's kind of pot calling, or it's kind of external, but my sense is they're somewhat more linear in the way they think, fairly buttoned down, like there's a process, we follow it. Right. And so for those employees, while you may be bought into the benefits of subscription model, higher valuation for your firm, better planning, sleep at night, et cetera, those employees may actually need the value proposition. They may need to be sold first because they may make or break your subscription model in my experience.
Well, that's fantastic. I think explaining it to your staff and to your team is critical. Once they understand it, they'll probably be more accepting to it in the long run. So I kind of like that analogy. I like the fact that you saw that in your practice. With regards to the value, you just brought up something that probably will perk a lot of owners of accounting firms. Subscription-based modeling has a higher value return on it, doesn't it? And if you could just discuss that a little bit.
Yeah. I mean, when an acquirer looks at your company, they're going to try to understand how's this business going to perform if the founder, the rainmaker of the firm steps away. And, one of the things that gives them a higher degree of confidence is if you've got recurring revenue, if you've got service contracts, simplified models in place with your existing customers, and you can show, the churn rate over multiple years is low, they're going to be willing to pay more for your company. I mean, it's just a matter of fact. So the more you can show recurring revenue, the better. And a lot of people listening to this, I think, and this goes back to the psychology of selling a subscription, will hear, oh yeah, like I'm not against billing, by the project or on an annual subscription basis, but I'm not going to force my customers into it, right? I'm going to have both. Like they can, buy my time by the hour or subscription. And my experience with that is that you have to give customers an ultimatum, because given the choice, customers will always choose flexibility. Right? You can tell them they'll blue in the face that you have a subscription model, right? And you can even give them a 10% discount if they buy your annual recurring revenue plan. But in the face of ultimate flexibility, like just hiring you when they need you, they will always choose the latter. So it's a false narrative. It's a false choice. You really don't have the choice. If you're going to move to subscription, you have to go all in. You can't give folks the choice. Because what you'll end up with is this sort of half-pregnant, weird business model where you get some of your customers on subscription and you get some on billable hours. You got to make everyone do a timesheet, and yet like the subscription guys suffer. Like it's just a dog's breakfast. It doesn't work. So if you're going to move to this model, I think you have to actually swallow hard and move to the model. Like you have to say, look, we've done the math, we've done the analysis. The best way we can serve you as a customer is to do it based on these annual contracts. And this is the way we're going to work together moving forward. If you choose not to do that, I can refer you to an external firm that I'm happy to give you 3 other firms' names, but we're not the firm for you. And I think when you have that kind of conversation with the business owners you work with, you will find that in most cases, they will move. If the value proposition is genuine and they see value in what you're offering, they will move. It's people who kind of approach it in a sort of half pregnant way, right? Say, oh, we've got this thing over here. We might want to move over here, but we're still happy to do business with you over here. That's going nowhere. It's like, it's never going to happen.
Well, I'm glad you made that clear, because I think you're right. I think when you adopt a business model, you basically have to adopt the whole model. Adopting 50% or 60% of a model never gives you the optimum return or optimum level. That's fantastic.
Yeah, you change. I mean, you think about like the way you incentivize employees, the way you manage them, the way you bill your customers, the way you measure profitability of your customers. It's like everything changes on subscription. If you just offer subscription and by the hour billing, you're effectively, doubling, if not tripling your workload, because you're just going to find yourself trying to keep these two models up in the air. And it's just way too hard to juggle.
Well, that's fantastic. That's great insight, by the way, John. Thank you. Before we go, I just want to talk a little bit about, you're the founder of the Value Builder system. And I would love to know a little bit more about that system and how that works. If you don't mind telling us a little bit more about that.
Yeah. So we have a way to measure the value of a small business and show the owner, by making some changes in their company, how they would improve the value of their business. And we license that system to accounting firms who use it as a way to start a strategic conversation with a business owner. Most of the accounting firms that we talk with are want to get out of tax and compliance work, and they want to move to a subscription model, or they want to move to providing more advisory services. And this is a way to do that. It's a way to like take yourself out of the kind of bean counter bucket that some small businesses kind of put you in, and into the strategic bucket. So you're starting a strategic conversation with the business owner about the value of their company. And then obviously you can back into how your services could help them improve the value of the business. So it's called Value Builder, valuebuilder.com for folks who are interested. Yeah,
that's great, because I really like one of the key concepts of accounting firms in general, or professional firms, is we do our meat and potatoes, which is what you just talked about, the bean counter bucket, right? But the area that we all love and we enjoy doing for our customers is the advisory. And I like your Value Builder system. I think that's a really good system. And you're right, we do like systems and processes. So having something that we can follow is fantastic. John, thank you again for spending time with us. I really appreciate it. It's been great. If someone wants to get a hold of you or wants more information, where can they go?
Valuebuilder.com.
So that's perfect. You heard everyone. Valuebuilder.com to get a hold of John. Again, John, thank you for joining us, and thank you.
Thanks, Louis. It was great to be with you.
John, once again, thank you for joining us today. And to you, our valued viewers, thank you very much for tuning into this episode. Please kindly subscribe if you haven't already done so. And as always, please send us your feedback and comments below. Until next time, stay hydrated and always be curious. Bye for now.